All right. Good afternoon, Ottawa. We are live. Welcome back to the Market Beat, episode number 84. I'm joined with the one and only Erica Vincelli with the Mortgage Advisors. Thank you so much for tuning in. Thank you so much for joining us. Happy March break. I apologize in advance if you hear screaming kids and a barking dog, and they're on alert right now to try and do their be on their best behavior. But sometimes it's out of my control. I've had some calls this morning, and it's kind of just and lots of apologies. So just it happens. They're home. I totally get it. They came back from a long morning walk. Hopefully that was enough for them to stay quiet for at least 15-20 minutes. Erica, how you doing?
I'm doing fantastic. Thank you so much. It's nice to be back, and I'm excited. It's a pretty busy March break, but and if you hear a dog in the background barking, I have no excuse other than she's a puppy and she gets away with everything because she's so damn cute.
Both our dogs are the number one fans of these podcasts. They join us occasionally. You will see it. So it's only normal for you guys to hear them barking. So, all right, guys, welcome back. We got a pretty cool topic. I think this is very important. We've had some questions about this the last couple of weeks. We're going to talk about equity. And we're going to talk about the cost of waiting. What does that mean for you as the home buyer? What are the pros? What are the cons? If you're thinking of getting into the market, but you're not sure. Now, before we get into that, Erica, please let us know, what are the current rates and what do we need to know?
Rates have moved. They are not what they were a year ago. But you know what the beauty is that they're still really low because they're not what you heard last year. And that's just because, I don't think anyone wants to be in the same position as they were last year. So that has to go along with rates as well. So your choice, do you want to live in that world or do you want to live in today's world? And I choose today. However, it is kind of a shock when you think of what the rates are. So right now we're looking at high ratio, anywhere from just under 3 to over 3. Refinances are getting up to 3.5, or non-insured mortgages are close to 3.5. And the bond yields are moving. They're changing all the time. So bond yields are a direct reflection of the fixed rates, and the Bank of Canada is a direct reflection on how prime and variable rates work. Our variable discounts have changed as well. So I'm looking at prime minus, in some cases, 70 for a refinance, prime minus, I think I can still get a prime minus 100 on a high ratio purchase. So they're still good. They're still great. I'm still a huge advocate for variable. I've had this conversation many times over the last couple of weeks, especially now that rates have changed. A quick recap. If you want to know how a variable rate is going to affect if you're an existing homeowner, your payment will change about $12 for every $100,000. Now, if you want to move to a fixed rate, you go to whatever their fixed rate is at the time. And in some cases, that's an increase of $200 to $350 in some cases. So if you want to jump that much to have the perceived security of a fixed rate, that's your call. But I've shown my clients how to combat inflation, how to combat the rate changes, how to preempt them, how to protect against them. They're not going to not happen, but how do you mitigate your feelings of the risk? So I have those conversations day in and day out. Happy to talk to anybody, whether you're my client or not. I want people to feel comfortable. The rates have changed. There's no signs of them not of staying the same right now. So we have to be mindful. But I will say that pre-COVID days, the rates are still lower than that. And so, they're not high. They're just not what you're used to seeing. So any questions, feel free to reach out.
Nice. Okay, so good to know. Again, guys, there are changes. We're going to update you on as they happen. It's been just some small changes for now, but again, you always have that option of fixed or variable, and then whatever you choose, there's options for each one as well too. So, all right, let's get into equity. We've had lots of questions. We're going to make this very simple. We're going to talk about what equity is, how we determine equity, and then we're going to look at a prediction that both myself and Erica made about a year ago, or just over a year ago, and we'll see where that prediction is based on today's numbers. So let's start off with what's home equity. Home equity, very simply put, is the difference between the value of your home and how much you owe on your mortgage. So let's say that the value of your home is $1 million and your current mortgage is $500,000. Erica, what do? We do one, subtract the other?
Yeah, okay, but we have to be very mindful of something because there's two ways to look at this. The first one is that you have, so in this case, obviously the math is simple. 1,000,000 minus 500,000 is you have $500,000 of equity. But what do you have as far as accessible equity? Okay, because if you're selling your house, you have to deduct the real estate fees, the legal fees, and penalty of your mortgage. So that will eat into your equity. If you're wanting to do a refinance, you can only use up to 80% of the value of the appraised value of the property. And therefore, you have $500,000 of equity, but you only have usable $300,000 of equity. So it's very important to know, what are your goals with your property. You can't just say, oh, I've got 500,000. That's your net worth. Your net worth, you have $500,000 net worth, but that's not it depends on what your purpose or your goals are to know how much usable equity that you have for either a new purchase or a refinance.
Yeah, and I think that's got to be probably the biggest mistake that a lot of homeowners make, is that they hear about how much the value of their home has increased. Automatically, they just do a simple calculation, right? 1,000,000 minus 500, hey, I'm at 500. And as Erica mentioned, guys, it's very important. There are other fees that you have to take into account. So once you meet with your broker, once you sit down with Erica, she's going to really calculate that out. She's going to give you a specific amount, because the question that I get as a realtor all the time is, okay, well, Andre, I'm not sure what it is. What should we start looking at? Well, you need to know that exact number. And even at that exact number, we're not going to push you to that max. We're going to look at what's available. What are those options within a certain range? So, all right. So, equity, it's, don't think of it too much. Think of it more in simple terms, what you can do with it. And we've talked about this all the time, right? Sellers, especially in the last 2 years in Ottawa's market, have kind of two options, right? They can sell their home, they can cash out, may make really good amount of money. Or what they can do is use the equity or the appreciation that's built up in their home, and they can decide what they want to do. Maybe they want to renovate their home. Maybe they want to buy an income property. So this really opens the door to options that you have as a homeowner using that appreciation. Now, I talk about appreciation all the time, and just to get everybody caught up that's not aware, 2020, we saw 19.9% year-over-year appreciation. So that means if the value of your home was $500,000, it grew by almost 20% in 1 year. In 2021, we were at 22% appreciation. So it grew even more than that, right? So if you do the math, 2020, and then you add 19.9%, and then the following year you add 22%, you get the idea. It's going up and up and up. Now, there were a lot of predictions for the start of this year, and they were very conservative, and they were all around 10%. Now, we just recently did a market report comparing January to February, and the numbers were well over 22% in just 1 month. Now, of course, there are still 10 months left of the year, and it could stable out a little bit, but we are right now in the same little window bracket of around 20% year over year. So that appreciation is going up. So of course, the question becomes, hey, what can I do with this? Well, like we just said, there are options. You can work with the equity, or you can refinance, or you can do home equity line of credit. That's what Eric is there for those specific questions. But definitely think about that, because while the opportunity kind of still is there. Now, to get into the second part of our conversation and our topic today, there's a lot of buyers out there that are questioning whether they should get into the market right now, within good reason, for sure, right? You always have to look at the pros and cons.
I get asked that question every day. Every conversation, is it a good time to buy?
Exactly, right? Is it the best time to buy now? Should I wait 3 months, 6 months, 9 months, a year? You'll hear the occasional people or the common objection, the bubble's going to burst and the prices will drop and they'll be what they were 3, 5, 10 years ago, right? So now, even though you're considering entering the market, what you have to ask yourself is, by me waiting, is it going to cost me extra money? So you're probably thinking, well, Andre, Erica, what are you guys talking about? That makes no sense. So first, let's start off with good reasons to buy a home, right? Some good reasons to wait. So we just a couple of random examples, right? So maybe you're thinking of getting a bigger down payment. We understand to purchase a house, you need a good, solid down payment. It's as low as 5%. Somebody might want to put in 20% or 30% or 40%, whatever the case may be. Maybe you're saving up for that down payment. That is a good reason to wait to buy a home. Number two, maybe your lifestyle is in a flux, right? You're thinking of getting married. You know, it's going to take some time. You're not sure about it. Maybe, you know, you're thinking of a pregnancy. That takes time, and you got to plan that out, right? Or you're not sure how long you're going to stay in Ottawa. Maybe you're like, you know, I'm only going to be here for another 6 months or a year. I'm leaving somewhere. Maybe it's a job or whatever the case might be, right? Or maybe your career path is on a potential and it's skyrocketing, and you're actually thinking, you know what, I'm going to wait a little bit. I'm going to get a little bit more income. I'm going to buy a bigger property if I wait now. That's a great reason to wait and buy a home. Or, of course, the most common one that we probably hear, both of us, right, Erica, is the conditions of the real estate market, right? We talked about the interest rates going up this year, and they're going to go up again. Or the lack of inventory means that there's less options for the buyers, right? I don't want to look at 3 homes. I want to look at 15 homes and then make a decision, right? So that could be a factor of a good reason to wait and buy a home. Now, those are good reasons for sure. And we totally support them. But what we want to also mention is the cost of waiting. So if I wait now for 6 months or a year, for example, what's that going to cost me? So we did this prediction back in 2021, the start of 2021. We used the previous year being 2020, the average purchase price back then. And by the way, just so everybody understands, the purchase price is an average of all properties, residential and condominiums. We're using a very general figure, but just so you can see what the numbers are. So back in 2020, the average price was $530,000. Now, fast forward to 2021, when we did this prediction, the average price was $653,000. And then we predicted that for 2020 is going to be a 12% increase at $731,000. Now you're probably looking at this and you're going, that's a high number. Guys, guess what? We under predicted by almost $100,000, because the last market report that we did, the average price for February in Ottawa for both residential and condominium combined was $834,000. Okay. But for the sake of this argument and for this tutorial, we are just going to use the numbers that we have in front of you. So we used a very 2% as the mortgage rate. We used a down payment of 10%, and that shows your mortgage amount. So for 2020 was $491,000, and your monthly payment with everything combined was about $2,000 a month. So just a very easy number to kind of follow along on, right? Now, back in 2021, when we made this prediction, we used the current numbers. And as you can see, both the mortgage rate changed. So it went lower. It went lower than 2%. Now your down payment increased. Now the reason it increased is because the average purchase price increased, right? So obviously if the price of the home goes up, your down payment, the 10%, is going to increase as well too. Your mortgage amount.
So your closing costs, don't forget your closing costs will go up too.
That's right. Closing costs change as well too. Mortgage amount changed. It grew by just over $100,000. Now your equity gained is what we like to talk about, or the appreciation of your home value, right? So from 2020 to 2021, it grew by $123,000. That's amazing. I mean, just looking at the purchase price alone from $530 to $653, you're going, hey, my home's increased. I mean, I'm in a good position. That equity is growing. You're right. That's great news. Let's look at 2022. Again, for the people that are just joining us now, we are using the numbers we predicted a year ago. They're a little bit off, a little bit lower. But again, for the sake of this tutorial, we'll use what we have in front of us. The mortgage rate has increased. So in 2 years, it went from 2% to 1.74 and jumped back up to 2.5%. Okay. Your down payment, the 10% that we're using for these examples, went from $53,000 to $73,000. So that's a $23,000 increase. Mortgage amount, of course, went from $491 to $678, and your mortgage payment per month, what you pay because a mortgage is it's a plan to borrow money to pay off the house. That's all it is, right, Erica? So it's instead of $2,000 a month that you could have been paying in 2020, you're now paying $3,000 a month. $3,000 a month is about $12,000 more per year because you waited 2 years to buy a home. Now, here's the most interesting part. Something that kind of me and Erica always look at in terms of appreciation of homes. Your equity just went down. It went down from $123,000 last year to $78,000 this year. Well, you're probably saying, well, how is that possible? Well, because everything else increased. You're paying more for the down payment and you're paying more monthly. So your equity just went down. So the purpose of this is to show you that, yes, we are growing year over year in appreciation and the home prices keep growing, but will it cost you more money if you were to wait between today, next year, 2023, 2024, and etc. Again, we just used 3 years as an example because this is where the market has been the most active. And of course, the next question is, well, if I wait another 2 years, the numbers are going to change. But you got to remember too, if you go back the last 25 years, and I've done videos on this where we look at the appreciation rate and the average home price, even back to 1980, and we have the stats that go back, there hasn't been any negative increases, right? So it's all the last 25 years is plus. So even if it's plus 2% or plus 5%, or let's say for argument's sake that next year is going to be plus 10%. So it's half of what it is this year. Is your house still growing? Is the purchase price still growing by 10%? Well, it is, right? So that's how you kind of have to look at it. So in the history of real estate, especially for Ottawa, we haven't seen a crash of appreciation. Can it crash drastically by 20% or whatever the current appreciation is this year? And the answer is probably not. And again, we've done videos on this and we've done lots of podcasts and discussions on this. There are a lot of positive supporting factors to support the prediction that something might crash, right? We have the population growth, we have the government sustainable jobs, Erica's favorite double income producers, right? As soon as 2 people apply on the application, Erica's like, yes, I can get you higher, approved for a much higher amount. And that's true because 2 people make more money, they're going to get approved a lot higher. So Erica, what do you think about these numbers?
Well, I find it really interesting to see, how much the properties have changed and how, on point and not on point we were. We're trying to predict as best as we can for people. I'm a mortgage agent. Andre, you're a real estate agent. We've been in this business. We buy homes. We sell homes ourselves. So we're doing our best guess. But it's a pretty insane number. I mean, I would never have thought. I still remember the day that the announcement was made that Ottawa has a average price home of $500,000. I think that was like close to the end of 2019, the start of 2020. And it was like, oh my God, we've hit that number. And now it's like, ping. So, anybody that bought in 2018, 2017, 2019, kudos for you for getting on that. Anybody that's waited, I get it. It is a very intense. It feels overwhelming. It feels almost like you can't get ahead. I love double income producers because, it obviously allows them to buy a house, but my heart goes out to the people who are single income producers that are really trying to get ahead. I feel for you. And I'm so sorry that this market is just not as forgiving for you as, it would have been a few years ago. I've always said that Ottawa is behind the curve when it comes to value. So is this going to continue? I don't really believe that the incline of appreciation is going to continue the way it is. It's unsustainable. Same thing with the rates. It was unsustainable for it to be that low. But I do not really think that the values are going to drop. Now, we don't know what's going to happen. A lot of people bought homes. One thing I want to say is that I've been asked a lot lately about, when is it a good time to buy? Should we wait a few years because we think that more homes are going to come on the market in the future? Just because more homes are on the market doesn't mean that the values are going to drop as a result of it. And, I think that now is a good time to buy. I think that, the best time to buy is yesterday. The second best time is today. But it also comes into what your goals are. So for somebody who's an investor, it might be a little bit scarier to think that you're investing all this money and what's going to happen with the property. But if you're going to be buying a home, let's say for, the long haul, then the dips might not affect you as much. Like you're not doing it for the purpose of an investment. You're doing it for the purpose of building equity in a home. You're doing it to pay down your own mortgage as opposed to your landlord's, and you're going to be in this house for a long time. So keep that as a contributing factor to the feeling of what you want to do. But you have to trust your instincts on this. If it's not the right time to buy for you, then it's just not the right time. It might be the right time for someone else, and that's okay. And it might not be the right time. And if you're somebody who does want to get into the market, and you are a single income producer, or you just don't make enough money at this time to afford what's going on in this market, look at outside of the Ottawa market. Look outside. Can you work from home? Would be something, in surrounding neighborhoods or surrounding areas. Brockville, Cornwall, like the smaller towns, is this somewhere you can live, at least for the interim, while you're building appreciation and come back to Ottawa? So you might have to think outside the box. Do you have a cosigner? Can you get a gift for down payment? There's a lot of things. It's an intense market, but with the right plan, you'll get there. But yeah, these numbers are insane. I mean, we're looking at this. it's scary to think that you're going to wait, and it's scary to think that you're going to jump in no matter what you do, but trust your instincts, trust your
absolutely.
gut.
And I mean, listen, you guys have to understand too, like we are here to show you the numbers, right? The numbers don't lie. We take kind of the emotion out of it, and we're here to counsel you based on what you're ready to do, right? So, I mean, I had, you know, if I have a buyer right now that has the flexibility of waiting 3-4 months closer to summer, I'm going to recommend to wait, because statistically we're going to see a little bit more inventory if you're looking for options. Now, if you're the person that has to buy within a month or two because that's your work situation or you're moving from a different city, we'll find you something. And you know, there are strategies to everything. So again, there's a lot of these questions, right? A lot of kind of uncertainties of, should I wait? You know, is it going to, am I overpaying, right? I mean, you guys got to understand, fair market value the last couple of years is what the buyer can afford, right? We're going to show you the comps. We're going to predict what it can sell for, but ultimately it is still a seller's market. It's all about supply and demand. And you have to have that information in front of you to make the best decision for you that makes sense, right? So it's still an interesting market. There's a lot of legislations that are set to come out as well that we'll be keeping an eye on. You know, there's a lot of immigration set to come to Canada as well too. The government wants to put plans to speed up the housing a little bit, give people more options, inventory. The question becomes, will it be enough for the people to satisfy the demand? We don't know yet. We need time for that. But we can tell you what's happening today. We can tell you what's happening the last year. We can give you a prediction based on the numbers, and then you can take a look at it and decide, does this make sense for me or not, right? I think overall, though, you're still in a very strong market. With the appreciation that we've been monitoring for the last 2-3 years, Erica, you're still in a good position to buy, knowing that it's going to give you some kind of return back. Now, I'm not the kind of guy that likes to say, you know, buy a property, sell it in 1 year, that's it, make your quick little money and get out. I look at real estate as a longer term investment. I really see the potential of it being a nest egg growing. And when something like that grows, you have the option to build a bigger portfolio like you have, Erica, where you have, you know, you started with one property and then you move on to a second and a third and a fourth, using the appreciation, using the market that Ottawa was able to give you to receive that return, right? So again, there are options, and we're here to tell you about all those options, good and bad. And again, same goes with interest rates, right? I mean, if another increase comes, we'll jump back on. We'll tell you what's going on. But as of today, just another quick little recap. Right now, on a fixed variable, or sorry, on a variable rate, it's $12 in every $100,000, right? The increase per month.
If the rate changes by another quarter point, you can calculate your payment change by $12 per 100,000. So if you have a $300,000 mortgage, it's a $36 or in and around $36 jump of your payment. But again, if you want to go to fixed, it could be a $250 or $300 jump. So which one would you rather? And I've had great conversations. They call me in a panic, and then, you know, their mind is put at ease after we have that conversation, because I'm always building the right strategy to say, okay, either apply the difference to your mortgage, or, you know, put that money in a separate savings account that you can't touch. So if you're saving $300 a month because you're not going to the fixed rate, well, that's money that you're banking. And then in 3 months, if it goes up by 36, 3 months of not paying 300. So 3 months of 300, that's 900. But now your payment is going up by $35. Well, you still won. So it's much easier when I speak to clients one-on-one, because when I generalize, it's hard for people to wrap their hat around it. So if you do have any questions, I'm happy to jump on a call with somebody and just show some of the way the numbers work. Because once we see with numbers, I don't really focus on the interest rate. I focus on the monetary value and the monetary savings. And that's where I think that makes the game changer for the clients to understand, knowing how much money they're truly saving.
Yeah, absolutely. And guys, one thing, please, and trust us on this, and don't do the numbers yourselves. I've been there. I tried doing it myself. I guarantee you're going to miss something. It's going to come out to a different amount, worse or better. And you want to know exactly how it's going to affect you, what the number is going to be, right? I mean, I'm the kind of guy that likes to calculate everything at the end of the month. I want to have everything down to a dollar amount. There's no sense of having this big question mark or something not calculated. So reach out. We'll do the numbers for you, and then you'll have a clear understanding of what's happening. Did we cover everything? Anything else you wanted to mention?
I think we're good.
We are good. All right, guys. That was equity. That was the cost of waiting. Any questions that you have, even if you're interested in the value of your home or how appraisals work or how we get these numbers to get your value, because remember, that is part of the process, right? If you're curious about your equity, we got to determine first what that value is. Erica steps in. She's going to look at the debts that are owing, what your mortgage amount is. We're going to give you a figure of whatever that X amount of dollars is. And then you have options to look at and you'll understand exactly the position that you're in. So thank you guys so much for tuning in. That was episode number 84. We will be back soon with another hot topic. Until then, guys, enjoy the rest of your March break and we'll see you soon. Bye, guys.
Bye, guys.